typically, given where interest rates are, the leverage points are capping out at around 70% realistically, unless you're in a very high cap rate market that can withstand the interest rates that we have. Um, but for the most part, it's a 1.0 debt service coverage ratio that we'll lend to. And that's based on our underwriting, our lender cash flow underwriting. And the difference between our cash flow underwriting and a borrower's cash flow underwriting is that we'll use a large swath of data that we have, proprietary data that allows us to get smart on the market quickly, but also be able to understand the true cost of operating an asset wherever it is in the country, whether it be in Florida or Oregon or in the Midwest.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investments from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Maxwell Wu. Maxwell is the founder of Fulcrum Lending, a direct balance sheet lender for multifamily properties nationwide. And in just a minute, we're going to speak with Maxwell about nationwide multifamily lending and credit investing. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Maxwell Wu. Welcome to CREPN Radio.
Darren, thanks for having me.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. So, my business is in commercial real estate lending, specifically multifamily. We don't lend on retail, industrial, office, hospitality. We have a deep focus in multifamily specifically, and that's in part due to my background, but also in part due to our hyper focus on credit. And we're true believers that, to be as competitive and perform at the highest level, you must have that specialization. Have been in the equity and debt investment space for over a decade. Started off in private equity, moved through investment banking and VC and principal investing roles. Ultimately found myself kind of going full circle back into credit and really more on the private credit side, lending higher leverage on multifamily properties. And, as the lender, as the originator, will hold the riskiest piece, and typically banks, financial institutions will take the more senior, safer piece. And there's a really great alignment of interest there, just given that if there is any, shortfalls in interest payments, we truly eat our own cooking, and we're the first ones to, take a loss there. Aside from that, I would say my background in just building businesses, I've been doing it since an early age, but real estate has been my focus for the past decade, and excited to see what 24 has for us in the store, especially in light of a pretty interesting 23.
Yeah, no kidding. Hopefully, good things to come in 24. Uh, Definitely be rooting for it. Well, hey, let me ask you a question here. So you mentioned a direct lender, um, and I just want to make sure I understand because when you were talking there, it sounded like you or Fulcrum takes a piece of uh, the the capital raise as opposed to like there's a bank I would assume the bank's going to be in first position. So are you in more of a secondary position or how are you tell me about how you guys structure your your loans.
Absolutely. Yeah, so I mean, really how we can be competitive in this market is really by offering higher leverage, but at a better price per pound. What do we mean by that? Ultimately for equity investors, it's about your cash on cash, your return on equity. And, for more leverage at the right price, you can oftentimes deliver a greater IRR, a greater cash on cash to your limited partners or to your capital invested. That's the reason why we structure it as such, not only to be competitive in the market, but to also create a product that's not only beneficial for our borrowers, but us as credit investors. Um, how the structure works is, we lend the full loan amount and we manage cash on behalf of these institutions. And again, because our capital is sitting right next to them in a subordinate position, there's a lot of trust that goes into that, but also, as mentioned, a lot of alignment that naturally occurs there and enables us to, provide higher leverage, but at a conservative and safe level.
Got it. So are you primarily um, providing like the capital needed for capital improvements, like on a new acquisition, if there's some sort of a value add strategy that, calls for renovations, are you providing that or?
So we'll provide capital for light value add. If you're ripping down the property to the studs and effectively, we consider that effectively new construction. We're not going to be the capital for that. We're lending on in-place cash flow. That's a really important, piece to remember. We're not lending off pro forma. Again, we are lending high leverage amounts. So with that, we must take the appropriate precautions and have the appropriate uh, sizing thresholds when we're making these loans. And some of those thresholds include in-place cash flow versus pro forma cash flow.
Yeah, no, I think that's uh, a number that as opposed to a number you're hoping for. So when you say high leverage, what kind of percentage of loan to value are you comfortable providing?
We won't go higher than 80% of value or cost. Um, Typically, given where interest rates are, the leverage points are capping out at around 70% realistically, unless you're in a very high cap rate market that can withstand the interest rates that we have. Um, but for the most part, it's a 1.0 debt service coverage ratio that we'll lend to. And that's based on our underwriting, our lender cash flow underwriting, and the difference between our cash flow underwriting and a borrower's cash flow underwriting is that we'll use a large swath of data that we have, proprietary data that allows us to, get smart on the market quickly, but also be able to understand the true cost of operating an asset wherever it is in the country, whether it be in Florida or Oregon or in the Midwest.
Well, 1.0, that's pretty I mean aggressive from a standpoint of I always thought the banks, they always want to see like a 125 uh as
Right.
far as to which always kind of squeezes the deal a lot more. So So I guess let me ask you this. So the trade-off, I'm assuming, is the interest rate. You mentioned, you're making certain that it's something that's attractive for you and your investors. So what what kind of an interest rate are you, commonly seeing or offering based on what you guys typically do?
Right. So we'll typically offer interest rates in the range of, and we'll quote this in the spread, right? We quote in spread, but our rates are fixed. They're longer term loans. They're 5 years, not 2 years. Typically on 2 year loans, you'll see it over SOFR. For loans around the 5 year mark, going up to 10 years, you'll see priced over the match term treasury. So for us, right, our spreads are typically around 285 to 300 over the 5 year treasury. We'll lock that whole coupon, that coupon defined as your spread plus the treasury amount. We'll lock that about a week before closing. So that'll float until we close. It takes about 60 days to close a loan. For a 1.0 DSCR, our spread is closer to around 385, 400 range over the 5 year treasury.
Got it. Got it. And with that, is there a typical size of loan that you guys, or a sweet spot for a loan size?
So we won't go lower than five. Typically, sub 20 million is where we'd like to focus. It's a market that we believe is certainly underserved and overlooked by some of the larger players. And again, given the large swath of data and the technology that we have, we're able to operate, faster at a lower cost, thereby, delivering that benefit to the borrowers in the form of a lower rate, as I just mentioned, right? Our spreads, as you compare it to the marketplace, are quite competitive, and that's a result of how we've built the business.
So are you I guess the primary borrower, are you seeing it typically syndications, or are you finding individual investors, or who's the typical borrower?
So our typical borrowers are, I'll give you an example. Someone that leaves a KKR or a Blackstone, and they want to go. They're used to cutting, let's call it $50 million equity checks, and they want to go off on their own, raise some money, start off small, do something in the 10 million to $15 million range, something sub 20. There's that profile. So we call it, institutional, sub-institutional, high net worth family offices, generational real estate families. That's also a large portion. And then there's also, emerging managers that we'll call them that. And these are, sometimes syndication groups. We're quite selective in the syndication groups that we work with. Sponsor qualification is really the biggest, I would say, hurdle that some of these syndication platforms have. But that being said, right, barring any kind of the headlines that you see out there, we welcome those platforms, and so long as the right processes are in place.
Got it. Have you seen an uptick in I guess syndication, sponsor, I don't say failure, but just challenges here with the recent market?
I mean, I won't mention names, but again, I think folks are seeing the headlines in the trades, and what you're seeing is that a lot of these syndicators have taken on large amounts of leverage 2 years ago, 3 years ago. They're struggling to really recap the asset. Typically, the debt that was taken on is short-term floating rate debt, and once they implement their value add plan, their intentions are to refinance the property with longer term conventional debt. Right now, just given interest rates, it's really a credit crunch. So again, going back to being very selective, our criteria is market, asset, sponsor, and we want to make sure all three stand on its own feet, right? And what we mean by that is making sure that the property is being operated at the thresholds that we believe um, is serviceable, right? We don't want folks going in and slashing expenses to a degree where it impairs the property and impacts lease up velocity or tenant satisfaction and I would say poor performance is manifested through bad debt and pet tenants not wanting to pay on time. So all these details in terms of operation are so important when evaluating the asset. And then there's of course the property level, making sure that the rents are durable, there is growth in the area, there is not a large amount of supply creating headwinds. And then the market really we want to make sure that strong population growth, net population inflows, good AMI growth, good renter population. We're looking at a multitude of factors there, but all that is to say is that if they check the box on all those three, we're happy to be that rescue capital to let the sponsor live another day, because again, if we believe in the asset, the sponsor, in the market, there's no reason why we shouldn't put our money there and give them more time, because I think it's only a matter of time till interest rates come in. I'm not going to call a time or a period in the future when it will come in, but what I will say is that the threshold we're at today is something that cannot be sustainable in the long term. And if you have a long-term view, like we do, and many equity investors do, you think 5 years should be long enough. So if they can hit those three boxes, make sure that all those are strong, we're happy to lean into the deal, provide that rescue financing, and they'll be able to syndicate or maintain their investor base. For new acquisitions, they may be able to continue to syndicate out so long as they can get the capital that they need.
You mention it as you call it rescue capital, and I think that's pretty aptly put on some of the things I've seen. Are you flooded with opportunities right now? Borrowers looking to refi rather than sell?
Right. I mean, the great thing about this business is that these loans, unlike single family residential loans, what we'll define as 1 to 4 units, those are all those are 30-year term loans, 30-year amortization. Ours are term loans, 5, 7, 10 years. Every 5, 7, and 10 years, these loans have to roll. There needs to be a new loan put on it. So there's always a constant demand for our product. And again, it's just being in the right place, right time with the right product. And you can, serve a great need. Sure, the short answer is yes. But again, you have to be very selective given the criteria I mentioned before, and choosing your spots where you deploy capital. Because in this market, things are trading very thin and the bid asks are very wide. So you got to be ready to have your capital out there for a long time. And again, that's our business. It's putting out long-term capital in these illiquid positions and really leaning into the future, seeing the future with these sponsors.
Question for you on the capital that you are lending. Are you raising that from individuals, institutions? Where's your how do you go about raising your capital?
Yeah, it's all institutional capital.
Okay. And do you do deal specific, or do you have a fund?
They're separately managed accounts. So combined, we have about $500 million of lending power there.
Okay. Um, in my preparation for this, I had kind of understood that you guys are using some of the fintech for your business. Is that, did I get that right? Or do you use any of the fintech?
That's right. That's right. Our fintech platform enables us to not only qualify, but also underwrite, diligence, structure, and service our loans all the way through. We're can offer the full suite of services in one shop. So there isn't you're not being kicked around to multiple people. It's a process that's connected by our technology from the loan itself all the way to our investors, which invest with us. And that technology allows them to also have, a finger on the pulse of how the properties are operating at a very, very fine level. But the other benefit that borrowers also get is they benefit from a large amount of the data that we use to underwrite. So I'll give you an example. We had a deal come in and borrowers seeking, $20 million, and they think that threshold could clear all day. When you take a look at the underwriting that they had on the deal, what you realize is that the per unit expenses that they're running relative to the comps in the area were quite thin. And we brought that to their attention and said, hey, look, I think insurance needs to double. I think real estate taxes need to go up 30%. And in repairs and maintenance, you're not going to be able to do this thing for less than, $500 a unit. And that's really, really thin. So, all that is to say is that we provided the information for this sponsor that was investing out of market. And what they were able to take was, hey, thank you for this information. We've rewritten our numbers and now understand that actually this deal, cannot actually stand on its own 2 feet unlevered. And, we're going to walk from this deal. As lenders, right, we want to be able to do the loan, but we can't do loans that don't make sense. And we certainly don't want our borrowers getting into a transaction that doesn't make sense for them. By providing that information, right, using our technology and data, it allows them to make smart decisions. And the saying goes, some of the best deals you do are the ones you don't. And by helping them sort out the good from the bad, we're not only providing them a better experience, but we're also protecting our investors and protecting them as investors.
No, I appreciate the kind of the walkthrough of how you guys underwrite, because I was kind of curious. I'm certain, lenders are going to take a look at the numbers and try and get a feel for something, but to be familiar with the line item cost and to know whether or not, particular zip code or an area or what have you is maybe not hitting the mark. I would think that'd be critical to your underwriting. I'm just kind of curious, how often do you find that the borrowers are not on point with their numbers?
Again, we're selective in the sponsorship and the borrowers that we work with. So typically they've been local, they've been in the market, boots on the ground for, a decade, more than a decade. They're able to show, their prior performance and actually track record on how properties have performed. They may have certain synergies because they have in-house property management. They have, a good relationship with their insurance, right? They may have an umbrella policy, so forth. But all that is to say is that, for the guys and gals that have been around for a while, it's quite strong. But for the folks that are just getting in, just starting, we see them have a little bit of trouble, but there oftentimes isn't pushback when we're giving them feedback. It's often thanks.
Yeah. No, I would think that would, like I said, some of the best deals you do are the ones you don't. Makes a lot of sense. So with the fintech, you guys have like an app, or do you have is it a website, or how do you go about integrating
Yeah, so our it's a website, it's a web app where people can go on and they can actually input, 5 to 7 pieces of data, and we can give them a quote very quickly within 30 seconds. We're able to, size the property within that time period and give them exactly how much money they can get and how much it can cost. Sometimes that's all you need to be able to get a deal done. If you don't know how much your debt costs and how much you can get, very hard to buy a property.
Very true. Very true. So you guys operate nationwide, correct?
That's right.
And with that, how is it that as far as your platform and being familiar with all of the different areas, do you have databases that you scrub to kind of keep up with, or do you have input that you continue to finely tune, or
All the above, all the above.
okay?
More information the better, but we have multiple proprietary sources that will ingest data. And then there's also multiple purchase sources, right? Redundancy is important when you're working with data to make sure that it's full, it's robust, but also making sure that it's correct, right? It's good data in, good data out, bad data in, bad data out, right? It's a pretty simple equation there. So making sure we're using the right numbers and using the best sources is incredibly important.
So this is the first time I've ever thought this or thought to ask this, but I'm curious based on, having a platform that relies on all these different data points to try and, you know, like you said, be redundant and make certain that you guys have a good handle on what's going on. Uh, is there a function of AI that you guys are using for the information gathering, or is that not part of it?
So there's certain really what we've heard to is more machine learning and how we go comb through the data, organize the data, structure the data, clean the data, and then ultimately use it. Um, we use some AI applications and we're it's not actually launched out to the public. It's really more of an internal tool, but we'll use that to help create market summaries and create certain memorandums for markets for the property to just help bring the information together and tell us in a clear and concise way what all we found. That helps us get from 0 to 90 very quickly. That being said, right, that last 10% I often say is where the money's made or where the magic happens, where we don't want to spend 90% of our time getting 90% of the way there and then 10% of your time with 10% of the deal left. We'd rather spend 10% of our time getting 90% done. How do we do that? It's by using technology, data, machine learning to get the deal to a point where it's 90% done. And then we can spend 90% of our time on the last 10% of the deal, right? And that flip of priority or activity rather is what makes the biggest difference when you're sizing deals and deciding how much more leverage you can go, deciding if the deal even makes sense, right? So it just allows us to be a lot more thoughtful in how we lend and how we evaluate markets, sponsors, and properties for that matter.
Yeah, that's a beautiful use of technology. I mean, and from a standpoint of being able to, essentially do a lot of the input to where you have something that you can, spend that majority of your time on the final details. I like that model. That's I hope that reaches far and wide because there's a lot of things that seems like we do every day that we could be done better elsewhere or differently. But it's good. Um, so nationwide, uh, multifamily. Um, is there, and we talked about kind of the size of the deals and kind of the asset, the borrower, and let's see, what was the other? The market, the
Mhm.
asset, and the sponsor, kind of the three things that you look at. Um, is there a market or a situation? I mean, we talked primarily about the borrower being the one that would be a no, or like if you're underwriting turned up, your numbers don't add up, kind of thing. But is there any kind of a situation right now where you're just seeing it just doesn't make sense, or that you can't get to um, you know, make something make sense? Just categorically, is there a particular type of risk or place that you're just not seeing it add up?
You know, I'm seeing a lot of, let's call it rent regulated deals where they're they're self-imposed by the sponsor. Those are ones, when you compare it to, um, you know, ones implemented by the federal government. The wherewithal or the value of it can only go so far, and that's one where it takes a lot more time, because ultimately with these abatements, right, it's a lot of cash flow being sucked out of the property, and then that's really more financial engineering. So I guess, in so few words, right, anyone who's performing, let's call it a huge expense reduction at the property and cutting it below where we think market is, we won't touch those deals, because, you know, there's got to be a threshold of operating the property where, you're not skinning flies and fleas, rather than and making the property less desirable, less inhabitable uh, for tenants, right? Um, I'd say other deals that we're staying away from are older vintage, 70s, 80s vintage. It was a very popular trade, I would say, over the um, last decade or so. And what's happened is, you've seen it, and I'm sure a lot of your clients have been buying a lot in the Sun Belt, and you've kind of seen the pricing run up there. Lifespan on these assets, let's call it depreciable, right? Life, 40 years. We're kind of at that end, right? That being said, right, we're here in New York. Some of these buildings were built in the 1900s, in the late 1800s, and they're still standing. That being said, if you've gone into a apartment building that's built in 1890, you'll notice that the floors aren't too straight, and that, maybe the doors don't close all the way because the the doors are crooked, right? Point being is that those are all structural issues that we don't want to live with, and we certainly think adds a lot more friction carry cost to the property for the borrower, a lot more unexpected large items that come up as unexpected costs. So we like to, stay away from those, and focus on the newer vintage properties in markets that have strong tailwinds.
No, spoken like an insurance underwriter. 30 years and newer is what they want. So that's uh that's what we're saying. So, hey Max, if we could, I'd like to shift gears here for a second. Um, as I've mentioned, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. It could be your borrowers, investors, interest rates, market, whatever you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Maxwell Wu, what is the biggest risk?
I think the biggest risk, you know, right now in this market is price fluctuation, right? Investors do not like uncertainty. It's almost like a natural thing that the universe wants some order there. And we don't have a threshold to go off of, a baseline to go off of. It's very hard to see what the future looks like. What do all those words mean, right? Again, you mentioned insurance, and I think a lot of investors, and I'm sure a lot of your listeners have noticed insurance costs skyrocket 30, 50, 100% of what it was previously. And that's for, a multitude of reasons that, we can drone on about. And, maybe that's something you're able to add in here, but aside from, cost of materials, labor, unexpected, natural events, natural disasters happening. These are all things where, folks didn't think there'd be such a destructive hailstorm in Texas, right? These are things that are truly anomalies, black swan events. Again, market does not like uncertainty. But how do you buttress against that, against these headwinds? You got to perform it appropriately and do that scenario analysis. And whether we do that for, line item expenses, or really on a more macro basis, what happens if interest rates go up another 50 bips, 100 bips, 150 bips? What's it do to the property, right? So sensitizing is a great way that we see to kind of hedge against risk, or rather go in eyes wide open and say, if this does happen, what's the result? What can we do, right? To your point, what is preventable? What are things that you can transfer risk on? So that's how we view risk, and that's how we assess it, and that's how we hedge it. But in terms of, again, answering your question, what do we think the biggest risk is the highest level is uncertainty, right? But if you want to be more specific with regard to real estate, insurance is certainly up there, and making sure that you have the right folks that have seen where policies were previously in high inflationary times, and in times of stress or limited credit supply, or liquidity in the market, right? All these things inform premiums and cost of really insuring these properties, which any lender you go to, any good lender you go to, is going to require that you have a very strong insurance policy on the property.
Yes, yes, indeed. And, there's a number of factors that are causing the insurance market to do what it's doing, but my hope is that the increase is slow to a manageable level, and that as the results come back more positive than what was expected, based on everybody trying to catch up to what they were experiencing, that you'll see more carriers come back into the market and be more willing to write business. And that's typically the cycle. But in the point we're in right now is you've got basically the uncertainty that you pointed out, which creates the fear. And literally, we have companies that they would not put this in writing, they would not admit to it, but they've essentially said to us, we are not looking to write any new business, because I think the notion is they don't know where to price it. And
That's right.
kind of the uncertainty that you're speaking to is definitely reflected in the insurance market right now. And but it will this is not a forever place. It's a point in the cycle, and we all cannot wait until it's over. Myself definitely included. But
Yeah, it's a volatile time. I'm curious. I mean, right, outside looking in, you look at these price increases. And, again, you read the same financial news I read, but what's often discussed is the stickiness of inflation, right? And, if if the market is accepting this price, right, and there's always this supply demand curve there, but how sticky are these price increases, on the insurance side, going up 30, 50, 100% of the prior year. In my mind, I don't see it decreasing by any times, but I certainly see the increases lessening and becoming more normalized like they were previously. But these are just enormous jumps that I find it hard to believe that they're going to come back down for any reason if the market's accepting it.
Well, the only thing that I'll add to this conversation is that unlike whether it be a widget or a building or what have you, insurance is basically it's a almost like a reserve fund that you hope you don't have to use. And the insurance company doesn't know if they made money until the end of the year. Whereas, compared to like a widget manufacturer, if they make 100 widgets and they price them at X and they sell out, and they can forecast demand to be, whatever it is, and they're able to more readily, especially with the digital age, and especially with the internet and Amazon, all these other things, to be more uh, I guess short term understanding what the market is. I mean, long term maybe not so much, but insurance, you set your price, and then all of a sudden you have some big weather events that exceed what you thought. You can blow up your model in a hurry, and uh, the reverse is true. If you set your price and nothing happens that you expected to have happen, you could have a great year. And one of the things that I've had to come to terms with, uh, that I don't know why it didn't make sense to me previously, is that I think in insurance a lot of times is viewed as something that they take your money and they hold your money, and that they're ready to pay out when you have a claim. The reality is that the insurance policy you purchase is a 1 year contract, and the insurance companies look at their money annually. They take in premium, they pay out expenses, which are claims and other things. But each year they evaluate their business. There's not this big pool of reserves that they're just sitting on waiting to pay a claim. It's a year to year business.
Hmm.
And that's the thing that I think that um, I mean, it makes sense that it's always been that way, but I think that for whatever reason, the messaging was more a matter of almost like put your money in the bank, for a rainy day, kind of thing. And it just could not be further from the truth. It's a year to year thing. I think the days of a long enduring relationship with a particular carrier um, are, sadly, it's not that way anymore, because you could sign up with somebody that promised you everything. They're going to be everything to you, and you have a claim, and they go, "Well, sorry, it didn't work out for us. You got to go." Uh, as opposed to, you are the risk. Max, you're exactly the kind of guy we want to insure, and we have a long history of insuring people like you and what you do and all this. And one slip on the banana peel, and Max, sorry, it didn't work out. We have other people like you that don't have claims. You got to go. And that's just like, what? It just doesn't make, it's been hard to reconcile from somebody that or for me anyway, as far as understanding just what the market is. But that's I think really kind of the modern view of insurance. And but it will it the time we're in right now, we will cycle through it. When the balance sheets look better than projected, others will take note and they'll come into the market,
Hmm.
and then you'll have more supply than you'll have demand, and that's when the price will soften. And so, will it reverse or regress to what it was? Probably not, but you'll see a discount. I first got into insurance in 1990 is when I got licensed, and we had just come out of a hard market. And for the first 3 or 4 years when I was when I was writing business. Rule was basically you had to be 10% lower in order to get somebody to move. So, you do that a couple of years, and you do see a price regression. So,
Interesting. Interesting. Well, there's hope. There's hope after all.
well, yeah, I mean, uh, we'll see. I mean, a lot of these, whether you want to, believe in global warming or not, I can tell you the insurance companies are paying a lot of claims, a lot of catastrophic weather-related claims. And that's probably that's one of the things that's really difficult to gauge. We've always had hurricanes in and around the Gulf. Historically, there have been tornadoes in the Midwest. Hurricane Alley has since moved kind of a little east. Now you have these deep freezes to where like places like Texas are having these these freeze events, and probably one of the biggest and scariest of the the events that are happening there is the wildfires.
Mm-hmm.
When I first got my license, there were stories of like the Chicago fire or the San Francisco fire or something,
Mm-hmm.
but they were like almost like anecdotal of like, what used to happen.
Mm-hmm.
Well, here in Oregon, we lost a couple of towns here a few years back. Hawaii just got, lost, I can't remember what the town was or the city there, but it's, wind and fire. It's not a good thing to have. So, but
Absolutely.
anyway, enough on that. Max, where can listeners go if they'd like to learn more or connect with you?
You can go on our website, fulcrumlendingcorp.com. You go to the top right-hand side, and there's you can create an account with us. You can reach out directly to one of our associates, and it's a platform that allows you to take a self-serve approach or work with one of our originators. It's good to have options there. So you'll be able to go on if you want to do self-serve. You'll be able to size and see how much money you can get and how much it's going to cost for your loan, just by putting in the information. 5 pieces, get it in 30 seconds. If it's something that's a little bit more complex or you're having any trouble, reach directly out again to one of our originators and they'll be happy to help you. But website's fulcrumlendingcorp.com.
Got it. Well, Maxwell Wu, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Absolutely. Thanks for having me on, Darren.
You got it. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Till next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.
You're listening to CRE PN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CRE PN Radio.